Good afternoon, everyone. Bruce Marziani here, your favorite Keller Williams agent. I hope, anyway. And if not, after you get done tuning into this video, hopefully I will be in the running, okay? So, we're here to talk about God, family, and business, and most of all today, we're going to talk about business, okay? So, we're going to talk about a topic that continues to pop up time and time again on all of my calls, and it is at the forefront pretty much of every residential real estate conversation that I have had, and that most of us have had for the last at least year, I would say, if not a little bit longer. And that is the topic of increased interest rates for buyers and the impact that that is having on our market at the current moment. I want to talk a little bit about pretty much what I want to talk about here is what we can do about it. This could be an extremely long video if I was to philosophize about why it happened, or what, sort of what is the culprit behind all of it, give the entire history of how interest rates have gone up and down over the course of decades. There's a lot that I could talk about. I want to try to focus, the primary focus of this video is to talk about what we can do about it now that it's here. So let's start with sort of a brief synopsis of sort of the housing crisis. So I cover primary markets are Westchester, New York, Bronx, New York, a little bit of the other 5 boroughs, and a little bit of Rockland, Putnam, Dutchess. In the various primary markets that I serve, last year's average home sale price was over $1 million, and so pretty steep for most American families. So basically you add up every single sale in the primary markets, divide by the number of sales in that particular property type, like the single family home, for example, and you're going to come up, if you do your math correctly, you're going to come up with a number above $1 million. Pretty steep purchase price for most American families. We sell the homes all the time, but pretty difficult to afford in general. And then you add in the idea that the interest rates have taken a hard increase in the last year or so. And on top of that, the inventory level has taken a steep decrease. So let's think about this. The home sale prices are quite expensive for most buyers. The inventory level is quite low, so there's not a lot of options. And the interest rates are also high in terms of recent times anyway. I mean, interest rates in past decades have been 15%, 20%, over 20% at certain times. But although the interest rates have been higher in past decades, they haven't necessarily been higher in recent years, okay, in very modern times. And the home sale prices are now, I suppose, pretty much as high as they've ever been. So, and higher, in fact. So a 7% interest rate, for example, or an over 7% interest rate in a market that is an average of well over $1 million is different than in 1984, when the interest rate was higher than that, let's say, but the homes were selling for literally hundreds of thousands of dollars less in some instances in precisely the same market. So, in other words, we're in a tough position if you're a buyer, for sure. And even in some instances, if you're a seller, because although you do have some advantage, it is a seller's market, and that I suppose that there's not a lot of inventory out there. There's not a lot of options for buyers, so they're all competing and bidding against each other to buy your home. So you have some advantage in that regard. But if the buying market, in terms of interest rates and inventory being low and the sale prices being high, in terms of those things, sellers can also be somewhat at a disadvantage, because a lot of buyers have literally been priced out of the market, and the market is not moving probably as well as we would like it to move. So anyway, that's sort of a synopsis of the crisis that's going on right now. Perhaps some of you are shaking your head. Yes, you understand what I'm saying. You agree with me. You believe what I'm saying. You've experienced it yourself. Whatever the case may be, what do we do about it? So all of these are solutions being offered by various lenders at this time and being suggested by good buyers agents. None of these are perfect, user-friendly options that always work perfectly every time, and everything's going to work out to be peas and carrots and unicorns and rainbows, and everything's going to be absolutely beautiful by the time we're all done. If you take me up on any one of these pieces of advice, it's not going to be perfect. It's imperfect in a lot of ways. There's positives and negatives, but that's the story of life. There's positives and negatives to everything. And if you want to buy right now, if you're in the market to buy right now, these are some things that you can consider. So the first thing are discount points. Let's talk about discount points a little bit. In a way, it's a discount. In a way, it isn't. So what you do is up front, you pay a monetary fee to the bank, which then purchases down your rate. So I'll just make up some numbers here for the purposes of illustration. Let's say your rate is a 7% interest rate, and that leads you to a position whereby you can't afford to pay the mortgage on that home. 7% leaves you with a monthly mortgage payment that is just too high for your abilities to pay. So what you can do is you can purchase some discount points. So you can potentially give the bank a monetary sum up front to sort of buy down that rate, so you're at 7%. Okay, you can give them some money up front and buy it down to 4.5%, or some sort of percentage that's a little bit more agreeable to you, a little bit easier for you to pay over the course of your 15-year loan or 20 or 30-year loan, whatever the case may be. So discount points. So in a way, it's a discount because your monthly mortgage payment goes down as a result of you buying these points. In a way, it's not a discount because you're shelling out some money up front that you wouldn't normally have to shell out if you didn't buy discount points, if you were just taking the loan straight on at the interest rate that they were offering. So there's positives and negatives to it, but it's an option for you if you want to consider it. It does help you to get a more manageable monthly mortgage payment. There's another thing called a buy down, which is a little bit less common, although perhaps being more common now, and being offered by more lenders and being verbalized much more than before. I'm a little bit less familiar with this particular approach. I hear rumors about it. I hear it being talked about all the time. I haven't tried it yet with any of my buyers. This is sort of like a discount point setup, but it's called a buy down, and it is sort of financed through temporary funds escrowed by the seller. The property has to appraise right. Both agents have to be in agreement. The seller's agent has to be in agreement with the buyer's agent. The seller and the buyer both have to be in agreement. The seller has to agree to get involved with it. The attorneys for both sides have to be in agreement. Everyone kind of has to work together. Mosquitoes are bothering me today. Everyone has to kind of work together to get the deal done in a buy down. The lender has to be heavily involved. Everyone kind of has to be on the same page, and that can sometimes be hard to do in a real estate transaction. Not everyone's going to have sort of different opinions on things, and it's sort of hard to get everyone to operate perfectly on the same page. In a traditional loan, it doesn't really involve the seller much or the seller's representation. You just kind of go with your loan, and there you have it. In this case, the seller side does become a little bit involved, so talk to your lender about it if you're interested in learning more. You're welcome to call me. I can put you in touch with some referred lenders. They can talk to you about it some more. If you can get everyone on the same page and everyone working together, and everyone working harmoniously towards the end goal of getting the property sold, then it can work. Again, there's positives and negatives to it. It's an option for you if you'd like to consider it. There's something called a step-up method, which again, I'm not perfectly familiarized with. A loan officer might be better to describe it, but my understanding of it is that let's say you have a 7% interest rate, and I'm making up some numbers now. You have a 7% interest rate. When you first purchase the property, you'll start off at, like, let's say a 4 or a 5%, something a little bit more manageable to you. Then 6 months in or a year in, it'll go to 6%. And then like another year in or some agreed timeline, it'll go to the 7% then at that point. So you're not perfectly getting away from the high interest rate, but you're giving yourself a little bit of leverage in the beginning, and that can be helpful for you. You know, if you're trying to get in the door, and it is a bit of a savings. Again, not a perfect scenario. Okay, you are eventually going to have to pay that 7% or whatever the agreed interest rate is, but in the interim time, from a temporary position, you'll be paying less. So sort of a step-up method. Different lenders might call it different things. I'm describing what my understanding of what it is. Some brokerages are offering a buyback clause. So in an effort to get more homes sold, some brokerages are large or have a good footprint in the market. Some of them have investors that are working there, and if after the first year of purchasing the home or some timeline that is offered, if things don't go well and you're not happy with the home or you can't afford the home or whatever it is, that real estate company will buy back the home at the same price that you bought it at. The positive of this is you have a security blanket if things don't work out a year later with your purchase for whatever reason. There's positives and negatives to this one too. The negative would be, of course, if the market goes up, like let's say you pay $1 million for a property and that particular market went up in the last year, and now that home should sell for $1 million plus $1 million and 50,000, let's say. So let's say it went up by $50,000 over the course of the last year. Again, making up some numbers here. You're not going to get that extra 50,000. You're not going to get market value. You're going to get back the $1 million that you spent. They're going to buy it back at the same price that you purchased it at. So it's not completely user-friendly, but it is somewhat user-friendly in that if you need to get out of a situation, they will agree to buy it back. So, you know, again, there's positives and negatives to all of these, but there are things you can consider, and there are things that you can ask about. Talk to your agent about them. Talk to your lender about them, consider them, look into them. The last thing I want to talk about is the traditional refinance. So this is pretty straightforward. Refinancing has been going on for a long time. If you are a market guru and you have some sort of prediction on when the market is going to stabilize a little bit more and the interest rates may go down again, then what you do is you set yourself up to succeed. So for example, if you believe that the market is going to go, the interest rates are going to go down by this time next year, then you can purchase at the moment. You can pay the 7% interest rates for the first year. The anticipated market will go, the anticipated interest rates will go down by this time next year, and you can refinance at that time. So you started off at a 7% interest rate, you paid it for the first year, the interest rates went down, you refinanced, now your new interest rate is 4% or 5% or whatever it's going to be. If you think interest rates are going to go down, let's say in 2 years, sort of the same thing. You can purchase now at the 7%. You can pay the 7% for the first 2 years. The interest rates will go down to 5 or 6% or whatever it's going to do. And you can refinance at that time. So the whole idea of the refinance is purchase the home, pay the money, right? And then at such a time when the interest rates do go back to a more manageable number for you, then you refinance at that time. Potentially gone are the days where, at least for the immediate anyway, where the interest rates are 3% or below, right? We've seen that a little bit in recent years. I don't think we're going to get back to that at any immediate time frame. I'm not even so sure that we're going to get back to 4% or below at any immediate time frame. So, to go ahead and buy at 7 or 6 or 6.5 or something like that, wherever we're at, or whatever interest rate you're being offered based on your debt to income ratio or your credit score, it might be something where you can bite the bullet and live with that payment for a period of time until the rates do go back down again. And then you can refinance. So it's an imperfect setup because you are waiting for the market to make some changes so that you can do the refinance, right? You're waiting for an interest rate to come up that's a little bit more user friendly for you. We don't have a perfect idea on when that's going to happen. It is a little bit risky. If you're anticipating that it's going to happen in a year and it ends up taking a year and a half or longer, you are going to lose a little bit of money on that. So, there is some risk element to it, no question about it. But if you need to buy, or if you want to buy, this is an approach that you can take. So all these are different ideas. I would invite you to call me, text me, email me, reach out to me at any time. I'm happy to answer any questions that you might have. If it gets too intense from a lending perspective and I'm not able to answer the question in as much of an educated fashion as I would like to, I'm more than happy to put you in contact with lenders that I've worked with over the years that know a lot more about this stuff than I do. They work with it every day, all the time. They can answer any question from the standpoint of experience, and I'm happy to refer. So again, Bruce Marziani, Keller Williams Realty Group, Scarsdale, Westchester, New York. Thanks so much for listening. Appreciate your time. Call, text, email anytime regarding all of your questions about interest rates. Let's get out there and let's make some real estate happen. Thank you.